This is not a normal broadcast. Do me a favor. If your dog is barking, go tell them to be quiet. If you're at work, go tell your boss you need a break, a long one. You might not be coming back for a while. And if you're otherwise occupied on a private browser tab, close it. Trust me, what I am about to show you on the silver chart is more dramatic and more violent than anything you will find online. What's happening right now isn't a market move, it's a fracture. It's Tuesday, January 27th, 2026. The ticker says silver is hovering near $114 an ounce. But I need you to do something for me. Don't look at the price. The price is a lie. It is a distraction, a glowing number on a screen that tells you what you pay if you could actually find the metal. Today, that if just became the biggest problem in the world. The story is no longer about price. The story is about availability. The story is that the buy button is being systematically deleted from the global banking system. We have just received official, cold confirmation of a development that signals the end of the retail silver market as we have known it for decades. TD Precious Metals, the bullion arm of TD Bank, one of the largest, most entrenched financial institutions in North America, has officially, and without warning, suspended all sales of physical investment silver. Let that sink in. We are not talking about a local coin shop in Idaho running out of monster boxes. We're not talking about a website crashing because too many people hit refresh. We are talking about a tier 1 bank, a bank with trillions in assets, sitting at the very heart of the global financial web. And as of this morning, if you log into their precious metals portal, you won't see a price. You won't see an add to cart button. You will see a grayed out screen, a banner that reads, temporarily unavailable. Now, the usual voices, CNBC, Bloomberg, the financial press, they're going to try to spin this. They'll call it a logistics issue, a supply chain hiccup. They'll say demand is just unusually high. They're lying to you. This is not a logistics issue. This is a bank run. But it's not a run on paper cash. It's a run on real assets. And the bank has run out. The vault is empty. To understand why a giant like TD has suddenly gone dark, why they've pulled up the drawbridge and barred the gates, you have to understand the catastrophic, arrogant, and frankly suicidal trading decisions they made over the last 6 months. You have to look at the short. You see, TD Bank didn't just facilitate the silver market. They gambled on it. They bet against you. Rewind to when silver was trading at $40. Their proprietary trading desk, armed with charts and algorithms dripping with contempt, looked at the rallies and declared, "This is a bubble. The little guys are dumb. Let's short it." They initiated a massive short position, selling paper silver they didn't own, betting the price would crash back to $30. They were wrong. The price ripped to $50. Did they cover? Did they admit a mistake? No, they're bankers. They doubled down. At 74s, they shorted again. They hurled millions in paper contracts into the furnace, convinced they could smother the rally through sheer financial brute force. They thought they could break the spirit of the market, but they forgot one thing. You can't print silver, and you can eat to short a market that is being vacuumed dry by 1.4 billion people in India, by industries, by savers worldwide. The market ran them over. We've seen the trade data. We know the exact point of failure. TD Bank was finally brutally stopped out at $92.50. That's the moment the margin clerk tapped them on the shoulder and said, "Game over." They were forced to buy back their phantom contracts at the worst possible time, locking in losses totaling tens of millions of dollars. But the financial loss isn't the real disaster. Banks lose money all the time. The Fed just prints them more. The real disaster is the opportunity cost. Think about it. For 6 months, instead of using their capital to stockpile physical bars and coins, instead of filling their vaults to sell to you during the greatest monetary metals boom in history, they used every bullet they had to fight the boom. They wasted their ammunition shooting at a tsunami, and now, with silver at $114, they are standing there naked. Their vaults are empty. They can call the refiners to restock because the refiners are sold out until 2027. The wholesale market is broken. So they had one choice left. Turn off the website. Suspend sales. They are burning alive in a fire of their own making. This is a retail collapse. This is the moment the paper window slams shut. For years, the wise voices in this space warned, better a year too early than a day too late. Well, guess what? It is now a day too late for the customers of TD Bank. If you have cash in a TD account today and want to convert it to silver to protect yourself from the inflation raging outside your window, the bank is telling you, we cannot help you. Your money is trapped in the system. You can look at the number on your screen, see that you have dollars, but you cannot turn those dollars into the only asset that matters anymore. You are a bystander, watching the rocket ship take off while you hold a canceled boarding pass. And do not think for a second that TD will be the last. TD is the first domino. They are the first major institution to publicly admit defeat. But every other major bank with a precious metals desk is facing the exact same math. They are all short. They're all unhedged. They're all running on empty. We are witnessing the systemic removal of liquidity for the retail buyer. The sell button is being deleted from the interface of the global economy. Soon, you won't be able to buy silver from Chase. You won't be able to buy it from Wells Fargo. The only place you all will be able to get it is from the guy down the street who had the foresight to stack it 5 years ago. And he isn't selling for $114. He isn't selling for $500. So if you're sitting there with cash, waiting for a pullback, waiting for a dip to buy cheaper, you are playing Russian roulette with a fully loaded gun. There is no dip coming. There is only sold out. There is only suspended. There is only the silent gray screen of a bank that has nothing left to offer you but worthless paper promises. But if you think the panic at the retail level is bad, what's happening on Wall Street right now is a bloodbath. The retail banks are closing their doors, but the investment banks, the vampire squids of finance, have started to eat their own. We have just received confirmation that the first major head has rolled at the most powerful bank on the planet. We need to talk about Goldman Sachs. We need to talk about why the global head of precious metals trading has suddenly and without ceremony left the building in the middle of the greatest trading week in history. You don't quit your job when you're winning. You quit when you've blown up the account. While retail investors bang on the locked doors of TD Bank, something far more sinister and far more telling is happening in the ivory towers of Manhattan. We have moved from retail collapse to institutional purge. The first general of the paper army has fallen, and the silence from Wall Street is deafening. Multiple independent sources inside the industry confirm that Benjamin Ben Lane, the global head of precious metals trading at Goldman Sachs, is no longer with the firm. For those who don't follow the LinkedIn profiles of the financial elite, let me explain who this man was. He was not a teller, not a junior analyst fetching coffee. He was the king of the rig. He sat at the biggest desk at the most powerful bank, controlling the largest order flow in the Western world. He was the man with his finger on the button. And today, his desk is empty. His badge is deactivated. His phone goes straight to voicemail. The official PR statement from Goldman is, frankly, hilarious. They say he left to pursue other opportunities. They hint he was poached by a hedge fund. They want you to believe that in the middle of the most violent, historic commodity boom since the 1970s, the guy in charge just decided to quit and go play golf. Rubbish. You do not walk away from the table when the pot is this big. You do not leave Goldman Sachs in the middle of a supercycle unless you are escorted out. Let's call this what it is, a margin call termination. A you blew up the book firing. Here's the likely reality inside that trading room. Traders like Ben Lane are trained in a specific, arrogant school of thought, mean reversion. They believe markets are rubber bands stretched too far, and they must snap back. So when silver hit $80, what did he do? He shorted it. This is irrational. I'll sell here and buy it back lower. At $90, he probably doubled down. The retail idiots are wrong. I'm Goldman Sachs. I will crush them. At $100, the sweat started to drip. And when it hit 114 alert this morning, the rubber band didn't snap back. It snapped his neck. You must understand the scale. At Goldman, they don't trade 10 ounces. They trade 10 million ounces. If you're short 10 million ounces and the price moves against you by $30, you have just lost the bank $300 million in a week. That's not a bad trade. That's a catastrophe. That's the kind of loss that gets you fired before lunch. This is the banker bloodletting. Ben Lane is the first casualty, but he is the canary in the coal mine. His exit screams one thing. The banks were not positioned for this. They were not long and strong. They were short and wrong. They believed their own lies about transitory inflation and dollar supremacy. They bet the house on it. Now, consider the psychology on the remaining trading floors. Imagine you're at the JP Morgan desk or Citigroup. You see the news that the boss at Goldman just got fired for fighting the trend. What do? Do you keep shorting? Hell no. You're terrified. You don't want to lose your 7-figure bonus. You don't want to be the next one carrying a cardboard box out the door. So you stop shorting. You might even start buying to cover your own position. This is how a short squeeze becomes a banker panic. The fear of being fired is now a fuel rocketing the price higher. The human wall of arrogant traders who sold paper to cap every rally has been removed. The resistance is gone because the resistors are broke. And while the West fires its traders and closes its banks, the East is doing something completely different. They're not looking at charts. They're looking at vaults. The price action coming out of Shanghai overnight isn't a rally. It's a glitch in the matrix. A move so violent it looks like a typo. We need to talk about $122. While bankers in New York pack their belongings and Canadians stare at sold-out screens, the real event, the one that effectively ends Western financial hegemony, is happening 7,000 miles away. Look at the scoreboard from China. What happened overnight on the Shanghai exchanges wasn't trading. It wasn't a spike. It was a teleportation. The closing data is the kind that breaks algorithms. Silver in Shanghai did not go up, it exploded. It closed up 12.78% in a single session. The price is 122.95 per ounce. Let me repeat that for the traders in London and New York who are struggling to find metal at $120. That is a gap of nearly 9 per ounce between the paper price in the West and the physical price in the largest consumption market on Earth. This 12% move is a limit-up event. It is the market screaming that the currency is worthless. This is a sector-wide stampede out of fiat. Chinese investors and industrial buyers aren't asking if the chart is overbought. They're looking at the dollar and saying, it's going to zero. Buy everything not nailed down. But the price is just the symptom. The disease is the vault drain. We track Shanghai inventory daily. Today, another 7.3 metric tons of silver were removed from registered vaults, gone, withdrawn, loaded onto trucks. Total inventory is now down to a whisper, just 18.4 million ounces. Do you understand how small that is? That's less than what JP Morgan claims to hold in a single vault. That's enough to supply China's solar industry for maybe 2 weeks. They are running on fumes. And when a market runs on fumes, price ceases to be linear. It becomes exponential. It goes vertical because the seller knows he has the last bar. If you want the last bar in Shanghai, you don't pay $120. You pay whatever he asks. Tomorrow, that ask could be $150. This $9 spread between Shanghai and New York is the death knell for the Western shorts. It creates an irresistible vacuum. Why would a refiner in Switzerland sell a bar to London for $114 when they can put it on a plane to Shanghai and sell it for $122? They won't. They are capitalists. The metal will flow east, and it is never coming back. The banker bloodletting at Goldman Sachs happened because they were shorting a market that was being physically drained by a vacuum they could not control. They were betting against a physics equation. This is The Fracture. It is Tuesday, January 27th, 2026. The paper market is unraveling at the seams. The buy button is disappearing. The traders are being purged. The metal is fleeing west to east. This is no longer about investment. This is about survival. This is about realizing that the number in your bank account is just a shared illusion, one that is fading from the screen, replaced by 2 simple, terrifying words: temporarily unavailable. The temporary is becoming permanent. The paper promise is meeting the physical wall, and the wall is saying, no. The countdown didn't start today, but today the clock struck 0.